Larry Schembri as the keynote speaker for CABE's virtual conference. He's no stranger to CABE. He's presented at the Kingston conference in the past, as well as being an attendee. Larry became Deputy Governor of the Bank of Canada in 2013. In this role, he oversees the bank's analysis of domestic economic developments and shares responsibility for setting monetary policy in Canada. Mr. Schembri first came to the bank in 1997 as a visiting research advisor on sabbatical from his post as Associate Professor of Economics at Carleton University. He joined the bank permanently in 2001 and became Chief of the International Economic Analysis Department 4 years later. In 2010, Mr. Schembri was named advisor to the governor, a position he held until his current appointment. Mr. Schembri holds a Bachelor of Commerce degree from the University of Toronto, a Master's in Economics from the London School of Economics and Political Science, and a PhD in Economics from the Massachusetts Institute of Technology. His published research has focused on exchange rates and monetary policy in open economies, the international monetary system, and financial stability. The title of today's presentation is Perceived Inflation and Reality, Understanding the Difference. I will now turn the microphone over to Deputy Governor Schembri.
Thank you, Bonnie, for the kind introduction. Good afternoon. It's a pleasure once again to have this opportunity to speak at CABE's annual late summer conference, although the circumstances have radically changed since I last spoke to you a few years ago. The COVID-19 pandemic has disrupted all of our lives and imposed much hardship on many. When I was last with you, we were on the top floor of a Kingston hotel overlooking Lake Ontario. I felt tested to hold your attention given the lovely view. Today I'm similarly challenged, but by a virtual platform made necessary by the serious health threat posed by the virus. Je vais donc vous parler d'un sujet dont les banques centrales ne se laissent jamais l'inflation. Après tout, garder l'inflation à un niveau bas et stable est le principal objectif de la politique monétaire. J'aimerais toutefois aborder le sujet sous un angle un peu différent, en vous parlant de l'écart entre la perception et la mesure de l'inflation. As I just said in French, the topic I'll be addressing is inflation. It's a subject that central bankers never tire of talking about, since low and stable inflation is the core objective of our monetary policy mandate. However, I would like to offer a slightly different perspective to engage your interest, namely the difference between how people perceive inflation versus the actual measured rate. This issue is important because individuals' perception of inflation today and their expectations of it in the future influence their spending and saving behavior, and thus influence overall macroeconomic outcomes. Moreover, inflation expectations have significant implications for the credibility of the 2% inflation target and for the effectiveness of monetary policy. I would like to explore with you the observation that consumers, on average, think inflation is higher than what it is measured and reported by statistical agencies. This gap has been regularly observed in Canada as well as in other jurisdictions, and recent public outreach conducted by the bank has provided further evidence of this gap. As part of the process leading up to the renewal of our inflation control agreement with the federal government in 2021, we have sought out and are listening to the views of the public and other key stakeholders. One of the messages we have heard is that many people feel that the official Consumer Price Index, or CPI, inflation rate does not reflect the higher inflation they believe they are facing. This gap between perception and measurement has been more pronounced during the pandemic. In the most recent Canadian Survey of Consumer Expectations, or CSCE, we conducted this past May, respondents indicated they expected inflation to increase in the short term. In fact, the CPI inflation rate declined sharply over this period and has been below our 1% to 3% inflation control range. To examine possible explanations for this gap, the bank has been conducting joint research with Statistics Canada. In this speech, I will share with you some of the preliminary results before we publish our official findings this fall. And so today I would like to do three things. First, illustrate and characterize this gap. Second, explore some measurement and behavioral explanations of this disconnect between perception and reality. And third, examine the implications for monetary policy, including communications to different audiences. Let me begin by saying a few words about inflation and our inflation target. Economists define inflation as a sustained increase in the price level of goods and services in an economy over a period of time. While this concept of inflation seems straightforward, measuring inflation accurately is difficult. Fortunately for us, Statistics Canada measures it and we target it. That's what economists call an efficient division of labor. Therefore, measuring inflation is very important for us at the bank. Our inflation target of 2% is defined in terms of the annual CPI inflation rate. This transparent and widely reported measure holds us to account. We firmly believe that keeping inflation low, stable, and predictable is the best contribution monetary policy can make to promoting the economic and financial well-being of Canadians. The bank has had a good track record of achieving our target. Inflation has averaged close to 2% since we established this specific target in 1993, has been very stable since. But it's more than just a number. When people and businesses feel confident that they know what the rate of inflation will be, they can make better long-range plans for their careers, their savings, and their investments. Moreover, when low inflation is well maintained, price signals are more meaningful. Markets and the overall economy function better. And this leads to stronger and more stable employment and output growth. Our success in achieving the 2% target, however, depends on many factors. And one of the most important is the public's inflation expectations. Having a policy target that is well understood and trusted by Canadians helps keep inflation on target. Let's turn our attention now to the main issue I'd like to address today: the discrepancy between the measured rate of inflation and what some individuals perceive inflation to be. As I mentioned earlier, the average consumer tends to think they are facing higher inflation than both measured inflation and our target. We know this because we began to collect the views of Canadian households about inflation in 2014 through the CSC I mentioned earlier. This survey asks individuals what they think the inflation rate is now and what they expect it to be in the future. Let's explore some findings from our most recent survey in May, which are typical of past surveys. In this chart, our 2% target is the black dashed line. Actual CPI inflation is the yellow line. And you can see it came down sharply since the start of the pandemic, largely due to lower gasoline prices. Perceived inflation, the blue line, represents average perceptions across the households in our sample. It is generally well above reported CPI inflation, but close to our 2% target. And this perception gap has increased during the recent pandemic containment period. Turning now to inflation expectations, the 1 year and 5 year ahead expectations are the red and green lines respectively in the chart. 2 points are noteworthy. First, there's a positive correlation between inflation perceptions and expectations. In other words, when the perceptions of current inflation change, expectations of future inflation typically change in the same direction. Secondly, expectations are greater than both perceptions and our target, and they increase with the horizon. As an aside, let's quickly compare these Canadian results with ones for the United States taken from a similar survey by the New York Federal Reserve. This chart compares 1 year ahead inflation expectations, the dashed lines, with realized 1 year ahead inflation, the solid lines. Canada is shown in red, and the US is represented by the blue lines. There are two interesting observations that we can take away from this chart. First, US inflation expectations are generally higher than Canadian expectations and consistently above their 2% target. Now, this is despite the fact that the realized inflation rate has generally been lower in the US than in Canada in recent years. Second, the perception or expectations gap is generally much higher in the US than in Canada. To explore this difference further, let's consider the distribution of these expectations. Now, the mechanical explanation of this larger US gap is that the distribution of US expectations is much more skewed to the upside, which can be seen by comparing the US blue bars to the Canadian red bars in the chart. And you can clearly see they're skewed to the upside. In other words, relatively more respondents reported much higher inflation expectations. These results are taken from a recent study by some economists at l'Université de Laval. They note this difference may reflect different communication strategies by the Bank of Canada and the US Federal Reserve. In particular, the Bank of Canada has a single mandate in contrast to the US Federal Reserve, which has a dual mandate, low inflation as well as maximum sustainable employment. Our communication can be simpler, clearer, and more focused on the inflation target as a result of our single mandate. This creates a 2% inflation focal point for the general public in Canada. I'd like to now compare inflation expectations within Canada. This chart shows 2-year-ahead inflation expectations for Canadian households, the red line, firms, the yellow line, and professional forecasters, the purple line. Canadian firms and professional forecasters on average have inflation expectations much closer to our 2% target. In contrast, the expectations of Canadian households are generally higher. Clearly, firms and professional forecasters have a much greater incentive to forecast inflation accurately. They are basing important and more frequent decisions about price and wage setting, as well as financial decisions, on these forecasts. In contrast, because inflation has been low and stable for an extended period of time, households may choose to devote less effort. Such behavior is known by economists as rational in intention. All this being said, the gap between Canadians' expectations of inflation and those of consumers, firms, and market participants and our inflation target has been relatively small. These well-anchored expectations have supported our ability to achieve the 2% target. Nevertheless, as a central bank, we don't take for granted that inflation expectations are anchored at the target. The credibility of our target is of paramount importance. Consequently, it's valuable to gain insights into why some households have a perception gap. First, let's consider some measurement issues. One explanation for the gap is that some consumers feel that the CPI consumption basket does not represent the goods and services they actually consume. In other words, they believe their consumption basket is different from the average. Let's look at this issue a little closer. To analyze this point, we constructed consumption baskets and associated inflation rates for different household groupings, including based on age, income, and education. For example, let's consider age. This chart shows the constructed inflation rate for young households, the purple line, middle-aged households, the red line, and older households, the green line. Total CPI inflation for all households is represented by the black line. It is striking that despite likely differences in consumption baskets, the decomposed inflation rates are all remarkably similar to the CPI rate. This same finding was obtained a few years ago when StatsCan was asked to construct a seniors price index, and is generally true for the other decompositions we considered, including based on income or education. Let me offer a possible explanation as to why this may be the case. Because prices tend to increase on average by 2% over time, given well-anchored inflation expectations, the impacts of differences in consumption baskets tend to wash out. Let's now consider the inflation perceptions of these households based on age groupings. This chart shows the perceived inflation rates taken from our consumer survey for the same cohorts of consumers: young, middle-aged, and older. The inflation perceptions of younger households, the blue line in the chart, are clearly higher and more volatile than the other two age groups. And they are certainly higher than the measured rate we constructed for them. Moving to the second measurement issue, let's talk about the principle of quality adjustment. To accurately measure price changes, the goods and services in the CPI basket should be of comparable quality over time. However, we know from our own experience that the quality of certain products, such as electronics and cars, is constantly improving over time. StatsCan routinely adjusts price movements for quality changes using various techniques, including hedonic pricing regressions. However, when consumers see prices rising, they may not take into account that there's been a quality improvement leading to an upward bias in their inflation perceptions. This chart shows that about 16% of the CPI basket is regularly adjusted for quality improvements. Cars, as you can see, is about 11%, and electronics is 5%. Interestingly, the prices of clothing, furniture, and rent are subject to an adjustment in the other direction, as quality is sometimes seen as deteriorating. On net, these quality adjustments have removed about 0.2 percentage points from the annual inflation rate on average in recent years. The third and final measurement issue I'd like you to consider is that consumers' perception of inflation is likely influenced by the price of houses. This is particularly relevant in recent years, when we've seen rapid increases in house prices in markets such as Toronto and Vancouver. The important point, however, is that the CPI basket includes the price of housing, or in other words, the price of services that a house provides, not the price of a house. Although the price of a house will influence the price of housing, a house, and especially the land, is an asset or a store of value that is not entirely consumed by the owner. Statistics Canada employs a user cost approach to estimate the price of housing services by adding the cost of home ownership, including mortgage interest costs and depreciation. Let's look at the data now for these two prices. The chart in front of you shows a comparison of the growth rate of these two prices. The price of houses is given by the blue line, and it grew at an average annual rate of 6% over the sample period, and as you can see, experienced a fairly rapid double-digit increase in 2016, 2017. The price of housing, shown by the red line, grew by only 2.5% over this period, less than half of the price of houses, and was much more stable. However, given that most households will purchase a residence over their lifetimes, it is not surprising that the perceptions of inflation are influenced by house prices. And that's indeed what we find in our research. There is a positive correlation between inflation perceptions and house price growth. While these three measurement issues offer plausible explanations of why consumers' perceptions of inflation are higher than measured rates, there are other explanations that are less tangible. In particular, the behavior of consumers, which is determined by psychology as well as knowledge, has been found to have a significant impact on inflation perceptions and expectations. Let's consider the first behavioral hypothesis. One hypothesis about consumer behavior that is often put forward is that price increases have a much larger impact on perceptions of inflation compared to price decreases. This behavior reflects a well-known psychological effect known as the loss aversion effect. People are generally more concerned about losses in income, or in this case, losses in purchasing power, than gains. Our research finds this to be true. In this chart, we have constructed a CPI index of primarily price increases, the blue line in the chart, by removing the bottom 20% of the distribution of price movements across CPI basket components. As you can see, the perceived inflation rate of consumers, the green line, moves more closely with this index of price increases than it does with actual CPI inflation, shown by the yellow line. In other words, using this price index to capture this behavior helps narrow and possibly explain the pronounced gap between perceived and measured inflation. This is especially relevant during the recent COVID-19 containment period when food prices were rising, roughly by 3%, but gasoline prices were falling by much more. We'll now consider a second well-known behavioral hypothesis. This hypothesis maintains that consumers pay more attention to the prices of frequently purchased goods and services, informing their perceptions of inflation. Evidence has been found to support this hypothesis in a number of studies for other jurisdictions. Interestingly, our research has not been able to detect such an effect in Canada. And this chart shows inflation perceptions, the blue line, the inflation rate for frequent purchases, the green line, and these frequent goods and purchases would include gasoline and food, and the inflation rate for infrequent purchases, which is the red line, and this would include everything else. As you can see in this chart, there is no obvious correlation between perceived inflation and the inflation rate of frequent purchases. Another factor that could affect how some consumers perceive inflation is their understanding of inflation and the economic factors that influence it. Improving their financial literacy could enhance their knowledge and serve to reduce the observed gaps. Many of you, including the Financial Consumer Agency of Canada, the Canadian Foundation for Economic Education, and provincial governments and school boards have been working diligently to address this important challenge of financial literacy. Given the importance of inflation expectations to our mandate, central banks also have a role to play. This includes the Bank of Canada. More about this in a moment, but first a recap of what we've learned so far. To summarize, we've established that consumers' inflation perceptions are generally higher on average than what is actually measured. We've looked at 3 measurement issues that could explain this observation. And we've also considered ways that consumers' behavior and understanding can shape the way they perceive inflation. What is the role of the Bank of Canada in guiding consumers' expectations towards their 2% anchor? And why is this important? Let's tackle the last question first. To do so, I think it's useful to begin with the existing inflation control agreement between the Bank of Canada and the Government of Canada. This agreement stresses the importance of the public's confidence and the credibility of our inflation target. Because inflation expectations are a key determinant of economic behavior and outcomes, it is important that the consumers understand the bank's commitment to the inflation target. The more confidence that Canadians have in this commitment, the more they will anchor their beliefs and their behaviors to this 2% target. Put another way, people will shrug off temporary movements in inflation if they believe that inflation will remain on target in the long run. Their confidence that inflation will remain close to 2% helps keep inflation at that rate by allowing the economy to stabilize after short-term bumps. As a result of this confidence, the bank has the flexibility to see through temporary movements in inflation. We can keep a steady hand on the conduct of monetary policy with the goal of maintaining inflation sustainably on target. However, in the context of a large and persistent shock, such as the start of a COVID-19 pandemic earlier this year, having a credible inflation target is even more important. With inflation expectations well anchored, the bank was able to effectively respond in March to this unprecedented adverse shock. One of the actions we took was to reduce our policy interest rates by 150 basis points over 3 announcements. Because inflation expectations were well anchored at 2%, this translated into a decline of the real interest rate of roughly the same amount. This decline supported consumption and investment spending by households and firms and helped promote demand through other channels, including the exchange rate. In contrast, if inflation expectations had not been well anchored, the reduction in our policy interest rate would have had less impact. Consequently, more monetary stimulus would have been necessary. Successfully keeping inflation close to target will help anchor inflation expectations, but what about the role of communications in this anchoring of expectations? In this role, the Bank of Canada's objectives should be to communicate often, communicate clearly, and communicate consistently to a wide variety of audiences that includes consumers, firms, and market participants. The bank has embedded this concept in our strategic planning. We are committed to knowing our audiences, their interests, and how best to reach them. Indeed, our research finds that when we provide households with practical information about the inflation target, they tend to shift their views towards actual inflation. In addition, we use other communications channels, including engaging in public outreach, offering explanatory articles on our website, and conducting education programs for students at all levels. All of these initiatives help us connect with the public, to explain the work we do, and to underscore why it's important to them and their families. We will also continue to consult on our inflation target renewal process. To this end, we just launched an online public consultation called Let's Talk Inflation. We're inviting Canadians to tell us what they think about inflation, our inflation targeting framework, and potential alternative monetary policy frameworks. I hope you will participate, as your views will be most valuable in shaping our thinking. I also invite you to share the survey with your contacts and networks. Let me conclude. Low and stable inflation is the core objective of our monetary policy. Achieving our inflation target depends critically on the credibility of the target and the anchoring of the public's perceptions and expectations of inflation. C'est pourquoi il est capital de voir et de mieux comprendre l'écart entre la perception et la mesure de l'inflation. Pour que la cible soit crédible, il faut mesurer l'inflation avec justesse. Nos recherches avec Statistique Canada en vue du renouvellement de la cible d'inflation en 2021 montrent toute l'importance nous y accordons. As I just said in French, acknowledging and better understanding any gap between perceived and measured inflation is very important. Public confidence in the target depends on measuring inflation accurately. Our joint research with Statistics Canada as part of our 2021 inflation target renewal process underscores our interest in this goal. Moreover, our communication strategies must strive to explain inflation, our target, and our policy to different audiences in a clear and accessible manner to deepen their understanding. Our ongoing efforts to reach out and listen to diverse groups of Canadians are helping to strengthen our communications. While we have benefited from having well-anchored inflation expectations in the past, this mooring will be tested by the rough economic waters caused by the pandemic. Our extraordinary policy actions have been firmly focused on attaining our inflation target by supporting employment through this difficult and protracted economic recovery. Through our words, and more importantly through our actions, we remain steadfast in our commitment to helping restore the Canadian economy and the economic and financial welfare of all Canadians. Thank you for your attention. Merci de votre attention. I would be happy to receive any questions or comments you might have. Thank you again.
Thank you, Larry, for this really interesting presentation. So to all our CABE members, there is a box on the right hand of your screen, and so we'd like you to submit questions. We have some already coming in, and so let me turn to the first question, which actually I think I pose. It's a question of whether the bank places more weight on consumers' expectation of prices or businesses' expectation of output prices. Could you comment on that?
Well, we place attention on all Canadians, whether they be consumers, firms, or market participants. All of them, their expectations are all important. And we have in the past conducted a business outlook survey, which looks at the expectations of firms. We've done that for a number of years. And more recently, we introduced the consumer survey that I mentioned that also asks consumers about their expectations of inflation. And so all those expectations, whether they be firms, households, or market participants, we do take into account in terms of our thinking about inflation now and the outlook for inflation.
That's great. So the second question is a two-part question. The first part is, how does the dramatic change in consumption patterns that has occurred during the pandemic affect monetary policy? And then the second part of the question is, will the bank largely be looking through the effect, assuming a return to normal expenditure patterns?
Very good question. So we've looked at that in our July NPR. There's a box in the NPR that looks at that. And in particular, what the point you make, Bonnie, is exactly right. There's been a big shift in consumption patterns during the containment period. There's been much more consumption has shifted away from travel, clothing and footwear, and gasoline in particular, towards other goods such as food and household expenditures on cleaning products and so forth. And so we've seen this shift, and we've tried to calculate what we call an adjusted CPI, which takes into account the fact that these baskets have changed. And we've tried to estimate these baskets using aggregate payment data, retail sales data, working in conjunction with Statistics Canada. And what we found is that it does result in a slightly higher inflation rate because the shift has been away from goods that are experiencing lower inflation towards goods and services that are experiencing higher inflation. So the inflation rate, this adjusted inflation rate, is slightly higher than the actual CPI rate, but only by a small amount, by about 0.3 percentage points in May. So the adjustment doesn't really have that large an effect on the inflation rate if you recalculate it with different consumption weights. Now, going forward, the issue is, will these weights return to their pre-COVID level as the economy opens up further and our normal spending habits return to what we had before the pandemic? That's an open question. I think there'll be some reversal of what we've seen, clearly, but I think could be some persistent effects in terms of travel and so forth. The other issue is to keep in mind for monetary policy is that we look at different measures of inflation. We look at core inflation measures to gauge where the economy is relative to potential. And so the core inflation measures are very important for us. And the other aspect is that when we conduct monetary policy, because it takes effect 6 to 8 quarters out, we're really looking at inflation down the road. And so if this reversal takes place, as you mentioned, we'll be looking at an inflation rate that has consumption basket weights similar to those that were in place before the pandemic.
Okay, that's great. Now we have a question about housing prices. How relevant is the new housing price in Toronto to the determinants of inflation expectations for long-term planning of Canadian businesses or Canadian households? Do you have any comments on that?
Well, as I mentioned in our research, we do find that house prices influence people's perceptions and expectations of inflation. So that in terms of what people perceive and expect, there is this effect of house prices on inflation perceptions. In terms of what's in the CPI basket, as I mentioned, what StatsCan tries to estimate is the price of housing services. And there are components within that user cost approach that are influenced by the price of houses. For example, mortgage interest rates. Mortgage interest costs are obviously influenced by the price of houses because the higher the price, the larger mortgages tend to be, and so that would influence the costs in that respect. The other aspect is that depreciation is also a function of the price of houses, and so there are components of the user cost approach that StatsCan calculates that are influenced by the price of houses. And so in terms of firms' behavior, I mean, in terms of the location decisions, that's going to be a function of, real estate prices, where they locate their production facilities. But that's a separate issue as opposed to how we actually measure inflation.
Okay. I have a question about inflation targeting. Do you see any scope for central bank inflation targeting regimes to take more of a path dependent on the average view of the inflation target in future?
Well, I
think this is really just...
What we have now, the way we describe our inflation targeting regime now is flexible inflation targeting. And so when we talk about flexible, we're flexible in terms of the horizon over which we bring inflation back to target. If there's a shock that moves inflation away from target, we're flexible in terms of the horizon over which, choosing a different interest rate path based on how quickly it'll return inflation to target. Normally, our expectations, we return inflation to target in 6 to 8 quarters, but we are mindful of the impact that we have on the real economy, and in particular employment and output. So that, we can take faster or slower paths depending on the impact of our interest rate decisions on the volatility of employment and output. The other consideration is also the impact on financial vulnerabilities. We could choose a different interest rate path because we're mindful of the impact on financial vulnerabilities. Now, this issue of average inflation targeting is, instead of looking at the annual inflation target, one would average inflation over a number of years. And that's something that we're considering as a possible alternative monetary policy framework to the one that we have now as part of our renewal of the inflation control agreement with the government. So we're looking at a number of alternative frameworks, and average inflation targeting is one of them. So there's a conference, by the way, tomorrow that is looking at, that the bank is hosting, that is looking at this specific question, and one can look at it online at the bank's website tomorrow. So if you're interested in looking at the bank's work on these alternative monetary policy frameworks, and we do have external discussants, academic experts that will be commenting on that. So we are taking a hard look at these alternative frameworks, and average inflation targeting that has this history dependence will be one of those alternative frameworks.
Okay. So the next question, as you mentioned, professional forecasters and analysts are better at forecasting inflation, but this reflects targeting a key financial metric, and consumers are examining their perceived reality. So the question is, how can policymakers communicate that CPI does indeed reflect consumers' reality?
Well, that's a good question. That's why we're doing this joint research with Statistics Canada, because we want to understand better why some consumers, not all consumers, on average, consumers think that the inflation they are experiencing is different than what's actually measured in the CPI. And as I mentioned, there's a number of different explanations, measurement issues, as well as behavioral issues that could explain this gap. And so I think it's incumbent on Statistics Canada as well as ourselves to better explain inflation and its determinants, so that people will, we can address this gap.
Okay. We have another question, and I think there's been a lot of discussion about whether the targets and whether it should be changed. But the question is really, how did the bank arrive at 2% inflation target? And I might just add my own twist on that. And what is the bank's thinking about whether 2% is the right number?
Well, the 2% target's been in place since roughly 1993. We started with a fairly wide band. When we adopted an inflation target in 1991, it narrowed over time to the 1 to 3% band we have now, with 2% as the midpoint. And over time, it seems that the 2% inflation target seems to balance the costs and benefits in terms of either having a lower target versus a higher target. And this thinking has been vindicated by other central banks, because most advanced economy central banks have an inflation target at 2%. the obvious examples are the U.S. Federal Reserve. Their inflation target is 2% within the dual mandate, and there are other advanced economies as well. The European Central Bank, their inflation target is just below 2%. So the 2% figure seems to balance the costs and benefits. And we've looked in previous reviews and renewals of our inflation control agreement. We've had a number of research programs where we've looked at the possibility of lowering the inflation target rate to something like 1%, something lower than 2%, perhaps 1%, or something higher more recently in 2016. And again, it seems that 2% roughly is the sweet spot in some sense, that it roughly balances the costs and benefits. On the costs on the upside of having a higher inflation rate is that inflation tends to be more volatile, and it makes price signals harder to detect. The problem of having lower inflation is that with lower inflation, you run to this the issue of the effective lower bound for interest rates, that nominal interest rates will generally be lower, and so there's less room to cut the policy interest rate. So balancing these two effects seems to be come out with 2% as the appropriate inflation rate. Now that's, as I said, the economic developments happen over time, and the balance of costs and benefits could shift. But given our research over the past 15 to 20 years, it seems like 2% is about the right amount, right level, and that's seems to be what the finding is by other central banks as well.
Okay, so obviously we depend a lot on Statistics Canada and the data they provide. So the question is whether the bank is working with Statistics Canada to ensure they have a consistent sample in the survey of household spending, or do you have any concerns about the survey and people responding to surveys in today's age?
Well, that's a very good point. I mean, there's concerns about the response rate to surveys. I think for the most part, Statistics Canada has been able to maintain a relatively high response rate, but I think the technology allows us to use other sources of information to look at the weights within the basket. As I mentioned, for the adjusted CPI, we've used payments data that we've obtained. There's also data from retail sales. So there's other sources that are now available because of wider access to more frequent data that's available via the web, for example. And so this technology allows us to potentially update and improve the measurement of the consumption basket weights. So it's not simply just reliant on the survey. We can draw from other sources to ensure that the basket weights are accurately measured.
Okay, we have one final question, and I think you addressed it, but someone seems to be asking about the consumption baskets by income threshold. I'm assuming that the consumption baskets differ depending on your age, and is that how you were able to explain the different CPI increases in the various age categories, and does this have an impact on expectations?
You're right, Bonnie, that the baskets do differ by age. Like if you compare seniors to younger households, seniors obviously would consume more medical-related services, and whereas younger households would consume more education-related services. And so there is this difference in weights, but as I mentioned earlier in my speech, that if you compare those two inflation rates constructed for those particular baskets for younger households and for older households, the actual age-consistent inflation rate is pretty similar to the average. And I think there's this underlying momentum of 2% inflation that seems to determine many of the inflation rates for different components within the consumption basket. And so even though the weights are different, they tend to wash out in terms of overall of the inflation rate for each age cohort.
Okay, thank you, Larry. That's great. On behalf of CABE, I would like to thank you Deputy Governor Schembri and the Bank of Canada for agreeing to present at our virtual conference. These are certainly unprecedented times, and it's extremely valuable for economists to understand why perceived inflation and reality are different and what it means for monetary policy in a world with so much uncertainty. Thank you again, and I look forward to other participants on the web call to join us for our exciting lineup of speakers at our CABE virtual conference. Thanks again.
Oh, my pleasure, Bonnie. Thank you for the invitation.
Thanks.
Bye now.